Good afternoon.
Good afternoon to you too.
Good afternoon. This is Katherine and Christopher Tipper of Hunter Benefits Consulting Group. This is Friday, and what happens on Friday, Christopher?
We have our on the couch, I can't believe it. By me forgetting my name. Okay, this is our on the couch, the Friday afternoon bourbon edition, and no, this is my first drink of the day. And what's today?
Oh, it's some crazy.
It's June 25th. It's International Seafarers Day. I had no idea that was
Ahoy,
a thing.
ahoy.
Yeah, something like that. So
where's our Chips Ahoy cookies?
at the store. All right. So, okay. Despite this lovely intro, our On the Couch video series is our attempt at being entertaining and amusing to help ease the pain of learning about things 401k and ERISA.
Well, stay tuned because we're talking about saving money today.
That's right. That's right.
Yep. There's the way.
That's right. Today's episode, I think, is a very good, helpful sales tip. It's about the credits for new plans. We've talked about this a couple times in the past, but in the past week, a number of advisors have been asking me about it again, so I thought it was time for another video. We'll be back. Oh, wait a minute. Hang on.
We'll always have heroes.
Yes. No, well, that's later. Yes. Bye. I mean, we'll see you in a minute. Yes, and we're back. All right, so before we dive into today's sales topic, it is time for our Washington update. And I haven't even checked with Kristina yet to see if we have one. Do we have one, Kristina?
We have, we have 2 Washington and 1 out west.
Okie dokie.
Updates. The one is the DOL has reopened the comment period for amendments to the prohibited transaction exemptions that was first proposed in 2013. It's because of the
8 years ago, right?
Yes.
Yeah.
But remember what happened to the stock market back in the past?
Yeah.
Not the far, far past, but just that past.
Yeah. It went up and down.
It went way down.
Yeah.
And part of the problem was that there were ratings companies that rated some stocks higher than they should have been.
Inflation.
And
Yeah.
Dodd-Frank
Yes.
introduced their Wall Street Reform Act
Right.
that said you may never use a rating, credit rating, to determine the exemptions.
Oh, okay.
Okay? But get this, they're supposed to use creditworthiness instead.
It's the same thing,
Alice
Well,
in Wonderland.
right?
I kind of thought it was.
Tomato.
Yeah.
Okay.
Yeah, so if you would like to combat and write your tomato,
I
tomato.
think we want to combat.
Yeah,
this.
you nuts. All right.
Yes.
And
Yeah.
what was the other one?
The other one is Treasury Regulation 1.4011-21D6.
Oh yeah.
That's
Oh,
a
that
snap.
one. I remember that one.
It requires that certain participant election forms be witnessed by the plan representative or be notarized.
You're just looking at you, babe.
Elections, joint survivor.
Oh, okay.
Yeah.
Oh,
Yeah.
The hard
okay,
thing
that
about
kind of-
during COVID, how do you get a notary to watch what you're doing?
Exactly. Well, you can do it electronically and they can watch you over the internet, and that's okay. But it was set to expire on June 30th.
Well,
And so they've extended it
Oh, that.
until June 30th of 2022.
Okay, so it's
Isn't there
not.
some kind of service too, notary service that came about during the COVID
Yeah.
Right, but
era?
it has to be allowed at the state level.
Yes.
Notaries are controlled at the state level, even though we're talking about something that is federal.
And if you met certain requirements, the plan representative could watch you over the
Right.
internet sign. So.
Yep. And then we've got news from Wyoming, Idaho, somewhere?
Colorado.
Yeah.
The Court of Appeals has decided that the Colorado statute that says when you divorce someone, they are no longer your beneficiary. And they have decided that ERISA preempts that.
Oh, okay, yeah.
which means that if you name your spouse and you get a divorce, that ex-spouse is still your beneficiary until
Still in
you
first place.
change it.
Okay.
Right, yes.
So
That's the way it is everywhere else, so Colorado's catching up.
well, they tried to
And run it.
end run it and say, no, they're divorced. He obviously doesn't want her to have the money. Well, and I keep thinking that if I just made my beneficiary designation my spouse at the time of my
Right.
death would cover it.
Right.
Although your spouse might be a little upset about that.
And the fact that you wrote it in pencil, but that's another story. So, yeah. Well,
Yeah.
but it makes sense that, since ERISA takes precedence over the
State.
determination of a quadro and all those other things, this just kind of
Which-
follows along.
Which just means if you are a participant in a plan, you better keep that beneficiary designation up to date.
Right.
That's
Or you're-
always the very best
which
advice.
we always, yes, which we're constantly trying to remind people.
Or else your children will be cursing you
Right,
after
so
your
at the
death.
end of this, like, subscribe, and all that other stuff, and update your beneficiary designation.
Yeah.
So, thank you, I think,
Yeah.
Kristina. Yeah, all right. So, Catherine,
Yes,
do you like free money?
I do, but I kind of don't trust it unless
You-
I know all the details.
You don't try, okay, so, do you remember that the Secure Act made 2 new tax credits?
Well, I remember one, but the second one?
Okay.
We need more details on the
All
second
right,
one.
so we'll get to that one in a
Because
second.
there's one that's been around for a while.
Right,
But
now,
they made it a little more juicy.
that's a good word, yes.
A little more juicy.
Juicy, today's word for more money. All right, so the first one is an enhancement of the old one. Once upon a time, you used to only get a $500 tax credit, okay? Now, you get a minimum $500 tax credit, worked out $250 per non-highly compensated employee, all right? And up to $5,000 a year. And what this covers is half of your expenses to set up and operate a plan for its first 3 years. Now, usually, most plan sponsors are writing checks to us, all right, whereas everything else comes out of the plan's assets. But if the sponsor is paying the record keeper hard dollar cost, that counts. If they're paying for education, if they're paying for anything like that during the first 3 years of the plan, they're theoretically eligible. And I know Kristina and I, before we were talking about this, there's a whole bunch of other things under the asterisks, but this is supposed to be a short video, so we're just going to leave it at this. It does not apply if it's an owner-only plan, because there's no non-highlies, and if you're coming from a simple. So if you had a simple and you followed up with a 401k plan, that's not a new plan
But it defrays some of the cost. But it's
for new plans.
for new plans. Though to always put a very fine line under the fact that it is a tax credit.
Credit, which means
you take how much tax you owe and then it goes against that. It's not a normal business expense. That portion you don't reduce.
right
like that,
you're
it's a tax credit.
The tax credits are reducing the tax, and obviously we're supposed to remember to say this all the time, is that you don't get to deduct the amount you get credited for. All right.
No double dipping.
No. So now the second one is, I think, a completely brand new credit, and that is for $500 a year to add automatic enrollment to either a brand new or an existing 401k plan.
Yay!
That really sweetens the pot
It
quite a
does,
bit.
yeah, right. Especially since we don't have an extra $500 a year in expenses in adding automatic enrollment. But anyways, so that adds up to 3 times 500 is $1,500, and that's for new or existing 401k plans. Okay, so not too bad,
Yep.
right?
So do you need to give anything briefly on what auto enrollment is or no?
Well, automatic enrollment means that the plan participants are passively in the plan. They have to actively unenroll or change their enrollment amount, the deferral amount to 0, all right? Whereas the old-fashioned traditional way is you have to actively sign up for the plan.
So everybody's jumps in and they're all in and then they have to opt out.
And they're deferring
And
without electing to defer. So they 3% or
Yep,
whatever.
Whatever. Yep. Okay.
Yep.
So now then, we've got some takeaways for today. There's 3 takeaways all the time. All right. So now then, new small plans can have up to $5,000 in tax credits per year. This does not apply, number 2, this does not apply to owner-only plans and plans that follow simples. And number 3, there's a 3-year $500 tax credit for adding automatic enrollment to a 401k plan.
But it does kind of take off the table a bit that it's expensive to start a 401k plan. It really defrays that a little bit.
Absolutely, yeah. We're cutting, for the vast majority of employers who are eligible for this, they're cutting their expenses in half for the first 3 years. Not a bad thing.
Yep, yep. So,
I think we're at the end, dear.
we're at the end. So, if you like this,
Please
please,
do.
please like it. Please follow us.
Please.
Share, comment, all that other stuff. And hunterbenefits.com for more information. And if you've got something specific to let me know, sales@hunterbenefits.com. Here's looking at you, kid.